Let's take a look at the opposite of that, which would be a non-trending or a slow market. What does a slow market look like? Well, in a slow market, we're obviously going to have lots of overlapping bars. It's going to be the exact opposite. In a trending market, we had very little overlap. Here in a slow market, we've got lots of overlap. We're going to have smaller bars versus the trending market that had big bars. We're going to see big wicks and tails, a lot of indecision on these bars. And the bars will take a long time to print. This is an advantage that intraday traders have over end-of-day traders, is that you can actually watch the bars unfold. And a lot of times, you'll watch the bar and it will be laboring to go anywhere. Again, the exact opposite of what would be happening in a fast or a trending market. The fast trending market, the market's pushing, you see a lot of activity, the prices are moving back and forth rather quickly. In a slow or ranging market, sometimes I got to check, make sure my data feed is still on because the market is just not doing anything. Prices are going to wander. There's going to be very little follow through. What does that look like? Well, here you got a picture of a ranging market. So you can see there's the odd big bar in there, even an odd series of big bars. But again, there's very little follow through, a lot of candles with very long tails to them. A lot of smaller candles, especially as you get later into the session. A lot of sideways trading. So how do you trade a ranging market? How do you trade a slow-moving market? Well, the challenge in a slow-moving market is not where to get in. That's going to be the easy part because the bars tend to be smaller. Things aren't unfolding as quickly. The challenge will be picking the direction. Now, a lot of people think you can't make money in ranging markets. I find I actually, as a rule of thumb, tend to do better in a ranging market than in a trending market. And I think it's because everything is moving at a slower pace. When the market is trending and moving fast, you're pretty much just hitting that buy or sell market button and placing a stop as deep as you can afford and just hanging on for dear life, hoping the market doesn't make a sudden reversal against you. But in a slow-moving market, you have time. You have time to watch the market unfold, the bars unfold. You can plan your trade, but the challenge, as I said, is picking the market direction. To that end, you should remember the 75% rule. What's the 75% rule, you say? 3/4 of the time, the market will be in a sideways trading range. So if you're looking at a chart and you're not sure whether the market is trending or moving in a sideways trading range, chances are very good that the market is in a sideways trading range because 75% of the time, the market is in a trading range. So there's your default answer. If you're not sure, assume that you are in a trading range unless the market shows you otherwise. When the market is in a trading range, or if you suspect that it's in a trading range, never trust a breakout. A good trading friend of mine used to drill this into my head. Never trust a breakout. Breakout trades look oh so tempting, and yet the vast majority of breakout trades fail. In fact, that's another part of the 75% rule, is that 75% of the time, a breakout will fail. It's just another way of saying 75% of the time, the market is in a sideways trading range. So if you suspect the market is in a sideways trading range, your job is to find the limits of the trading range, the upper and lower limits. And from there, you're going to buy low and you're going to sell high. So you're going to buy at the bottom end of the trading range, you're going to sell at the top end of the trading range, but you're not going to be greedy. You're going to go all in, all out, because the market's not going anywhere. It's a sideways trading range. You're going to take a scalp profit, maybe a small swing profit, but there is no point in swinging for the fences because chances are very good you're not going to get it. Unlike the trending or fast-moving market. If you suspect the market is trending or fast-moving, well then, of course, you're going to try to hang on a little bit longer. So here's that slow-moving market chart that we were looking at earlier, and you can see the little blue rectangle that I have there on the left side of the chart kind of highlighting the trading range. And then look at that big breakout bar to the upside. And what happens the very next bar? Yep, you got it. It reverses on itself and falls and breaks the bottom end of that earlier trading range. What happens after that, you ask? Well, you got it. It reverses on itself and goes and breaks the top end of the trading range, only to reverse on itself and try to head lower again. And you can see that every time it broke a significant swing low or swing high, the market tried to reverse and head the other direction. And it will continue to do so long as it is in a trading range.